You open your bank app, you're balancing rent and groceries, and you see a notification. Tax refund deposited. You think, nice, 50 bucks. That'll buy pizza. Then you find out your neighbor, same job, same rent, same number of kids, got a $3,000 refund. You stare at the screen and feel that little sting. Why them and not me? Here's the thing. That sting is almost never about luck. It's about information and habits. There are 3 tax credits that millions of Americans miss every year. They're real dollar bills you can claim to change your year, not someday, today. And for many people, each one can be worth $2,000 or more. I'm going to show you exactly how they work, why most people miss them, and how to claim them step by step. My name is John, and I spend way too much time thinking about tax credits and tiny, overlooked money wins. If you're someone who's working hard, juggling bills, and still feels like you're leaving real money on the table every April, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. The 3 tax credits almost nobody uses properly. The Earned Income Tax Credit, EITC, the Savers Credit, aka Retirement Savings Contributions Credit, and the Child and Dependent Care Credit. Each one is simple in idea, messy in the rules, which is exactly why people miss them. But the math? That's simple too, and better. The results are immediate. Here's what most people don't realize. Tax credits are not paper savings. They reduce your tax bill dollar for dollar. A $2,000 credit lowers what you owe by $2,000. That's not interest or projected returns. That's money that either goes directly into your pocket or prevents you from paying it out. For lower and middle income households, refundable credits can turn into actual refunds even if you owed nothing. And the scale is huge. The Earned Income Tax Credit alone is given to millions nationwide, and the average EITC payment is in the low thousands. But many people who are eligible don't claim it. That's cash. 1 Earned Income Tax Credit, EITC, a refundable credit for low to moderate income workers. It's large for families and meaningful even for singles. The average EITC payment is around $2,500. For many households, that's a month's rent. Savers Credit, Retirement Savings Contributions Credit, a dollar-for-dollar credit for people who put money into retirement accounts like a 401k or IRA. It's aimed at low and moderate income savers and is often missed because people assume retirement tax help is only for high earners. But the credit can be $1,000 or $2,000 if married filing jointly, and in the right circumstances, it's basically free money to save. Child and Dependent Care Credit. You get this when you pay for care so you and/or your spouse can work. Daycare, in-home care, elder care. For many families, it adds up fast. Depending on the rules in a given year, refundable or expanded versions of this credit can be worth thousands. The 2021 expansion and later rule changes dramatically increased potential value. The IRS still provides central guidance on how to calculate it. This is where it gets really interesting. These aren't borderline, nice-to-have credits. For eligible households, they're life-changing amounts, not hypothetical investments. Here's what most people don't realize about the Earned Income Tax Credit. It's designed to reward work, and it's refundable. That means if the credit is bigger than the tax you owe, you get the difference back as a refund. Basic idea. If you earn below a certain threshold, which varies by filing status and number of qualifying children, you may qualify. The credit rises as your earnings increase up to a point, then phases out. For families, that peak credit is significant. Real example, single parent with 2 kids, earned income, $28,000 per year. EITC at that level. Let's say the credit is about $3,000. That's $3,000 that could come back as a refund or lower your tax bill. Small change, big impact. If you were on the fence about filing, maybe you paid a tax preparer and thought it wasn't worth it. Realize that many eligible folks don't claim EITC because of confusion, past filing status, or thinking they don't qualify. The IRS and community tax sites estimate millions of people left eligible credits on the table in recent years. Psychology and behavioral angle. Claiming EITC often requires filing, even if your refund is small, and doing that filing feels like friction. Friction plus pride. I can handle this myself. plus misinformation equals missed refunds. That's inertia. Tax credits are low-hanging fruit, but they're on a tree that people never climb. Action steps for EITC. Use the IRS EITC Assistant online. It's free and will give you a quick eligibility check. Link in description. File your return even if your income is low. Many people wrongly assume, I don't have to file so I can't get credits. That's not true for refundable credits. If your taxes are complicated or you had changes, marriage, child custody, income shift, get a volunteer income tax assistance, VITA, site to help. It's free. HEAP documentation. Social security numbers for dependents, proof of income, and custody docs if applicable. Objection you might have. Isn't EITC only for extremely low earners? Now, you might be thinking that. But the qualifying range includes moderate incomes for families of multiple kids, and policy changes have shuffled thresholds, so always check. The worst case scenario. You check and you don't qualify. Best case. You find a $2,000 to $6,000 refund you didn't know existed. Here's what most people don't realize. The Savers Credit rewards the exact thing most financial gurus preach, saving for retirement. And it gives you immediate, dollar-for-dollar tax relief right now. Simply, if you contribute to an IRA or employer retirement plan, 401k, 403b, etc., and your income falls within the credit's limits, you can claim a percentage of your contribution as a credit, 50%, 20%, or 10%, depending on income bracket. The credit is calculated on up to $2,000 of contributions, $4,000 if filing jointly, so the maximum credit can be $1,000 single/$2,000 joint depending on rules and year. Concrete math example, married filing jointly. You and your spouse each put $2,000 into IRAs this year equals $4,000 total eligible contribution. If your income places you in the 50% credit bracket, you could get $2,000 off your taxes this year. That's immediate money back for doing exactly the right thing. If you're single and in the 50% bracket, a $2,000 IRA contribution could reduce your taxes by $1,000. Why people miss this? Two big reasons. 1. People assume tax benefits for retirement only show up years later as tax deferral, not an immediate credit. 2. Low-income people often don't owe much in taxes, so they assume a credit won't help me. But the Savers Credit is non-refundable, so it reduces taxes owed, not refundable, yet for people who do owe taxes, it's a direct relief and can combine with other strategies to minimize tax pain. Saving requires willpower. The Savers Credit lowers the hurdle by turning saving into a short-term reward. Instead of, I'll save because of retirement, think, I'll save because I get $500 to $2,000 back today. Action steps for Savers Credit. Contribute to an IRA or to your employer's retirement plan before filing. If it's after the year, you can still contribute to a traditional IRA up to the tax filing deadline and potentially qualify for the credit. Use Form 8880 to calculate the credit, or have your tax software do it. The IRS instructions explain the limits. If you're near the income cutoff, small adjustments, spousal IRA, timing contributions, can push you into qualifying. Talk to a tax pro if you're unsure. Don't confuse this with a deduction. This is a credit. The difference matters. A $1,000 credit saves you $1,000 in taxes, whereas a $1,000 deduction only reduces taxable income. But I don't owe taxes, so a non-refundable credit doesn't help me. True, if you owe zero federal income tax after deductions, a non-refundable credit won't generate a refund. But many middle-income households do owe some tax, and even lowering that by $1,000 to $2,000 matters. Also, use retirement contributions as part of a broader strategy. They reduce AGI and can make you eligible for other programs. This one confuses people more than any other credit, because the rules depend on who you paid, why, and how much. But the core is simple. If you pay for care so you can work, or look for work, part of that expense can be returned to you as a credit. Key mechanics. Eligible expenses are capped. Amount can vary by tax year and law changes. Check IRS guidance. The credit is a percentage of those expenses based on your income. For certain years and under recent law changes, The allowable expense caps and credit rates were significantly expanded, making the credit much larger for many families. Concrete math example: one child, post-expansion scenario. You pay $6,000 a year for daycare. If the credit lets you count up to $6,000 and your credit rate is 35%, you could receive $2,100 back as a credit. That's real money offsetting childcare costs. Even in more conservative versions of the rules, many families qualify for $1,000 plus per child. Important nuance: the Credit and Dependent Care Flexible Spending Accounts, FSAs, interact. If you use an employer FSA to pay for care, your eligible expenses for the credit may be reduced because you already got pre-tax benefit. You need to run the numbers. Sometimes FSA plus credit still wins, sometimes not. This is where planning matters. Psychology and behavior. Parents treat childcare as a fixed cost and forget to look for tax levers that reduce it. It feels like one of those impossible family expenses. But the government intentionally created this to help working parents. You just have to claim it. Action steps for child and dependent care credit. Gather documentation, provider's name, address, and tax ID/SSN. Receipts showing amounts paid. File Form 2441 with your tax return, or use software that autofills it. Run a quick employer FSA versus credit comparison. If your employer offers a dependent care FSA, calculate which results in a bigger tax savings for your situation. Some tax software will do this. Otherwise, ask a tax preparer. Check state credits too. Many states mirror or supplement the federal credit. But daycare is so expensive that a credit won't matter. That's exactly the problem. The cost is high, so even modest percentage relief is worth hundreds to thousands a year. Also, the credit scales with expense. The more you spend for valid care, the more you can potentially claim, subject to caps. Now for the part people sleep on. These credits stack. They don't all cancel each other out. For a working parent in a lower income bracket who saves for retirement, pays for daycare, and earns wages that qualify for the EITC, the combined effect can be massive. Illustrative combined example: fictional household, married, 2 kids, 1 income earner partially, and 1 contributing to retirement. EITC, $2,500, average-ish for certain income points. Child and dependent care credit, $2,100, 35% of $6,000 in child care, depends on rules. Savers credit, $1,000. Couple contributed $4,000 to IRAs and hit the 25 to 50% bracket. Total potential tax savings. Refunds equals $5,600 for the year. That's not rounding error. That's a small emergency fund, a car down payment, or a difference maker for someone falling behind on bills. And that's the low to moderate example. For some households, the EITC alone is higher. For others, childcare credits were larger under temporary expansions. The point is, these credits are not theoretical. Common objections and how to handle them. Objection: taxes are complicated. I don't want to make a mistake. Totally fair. But tools exist. Free Vita clinics, low-cost tax preparers who specialize in credits, and reputable tax software. Also, the worst-case scenario for most refundable credits is that the IRS asks for documentation. That's manageable. Objection: I read the rules and I still don't qualify. Then fine. You tried. But try systematically. Check again if your status changed this year. Marriage, kids, unemployment, job changes. The EITC especially has people newly eligible after life changes. The IRS reports millions of people missed expanded benefits in past years. That's structural, not personal failure. Objection: this feels like tax optimization for lower-income people only. That's a framing problem. These credits mainly target lower to middle-income households because policy aims to help working families. Think of it as targeted help. If you do nothing else, do this exact checklist this week. Gather basic documents. Last year's 1,040 W-2s, Social Security numbers for any dependents, receipts for childcare, and proof of retirement contributions. Use online eligibility tools. IRS EITC Assistant, and IRS pages for Savers Credit and CDCC. Bookmark them. If you have childcare costs, get provider info. Provider name, address, and tax ID/SSN. You need it to claim the credit. Make late IRA contributions if eligible. Up to your tax filing deadline, you can still fund an IRA for the prior year. That could qualify you for the Savers Credit. Compare FSA versus credit. If your employer offers a dependent care FSA, do a quick math comparison. Sometimes FSA wins, sometimes the credit does. File or amend. If you didn't claim credits in past years, and you were eligible, you may be able to amend returns to claim them. There are time limits, generally 3 years. The IRS Newsroom has guidance on missed benefits. Get help if needed. VITA for free help, or use reputable tax software. If you use a paid preparer, ask if they have experience with EITC and childcare credits. Let me tell you about Mari. Maria is a single mom working a retail job and also doing a gig on weekends. She thought filing taxes wasn't worth it because she barely made enough to owe anything. A friend pushed her to go to a VITA clinic. Turns out, she qualified for the EITC, $3,200, and she'd been eligible the previous year too. She got back about $3,200, plus a modest Savers credit after she contributed to a Roth IRA. That first year's refund paid off a bunch of debt and started an emergency cushion. She told me later she felt like she finally had a tiny runway. That runway came from credits, not from some aggressive investment strategy. Policy plus paperwork changed her life. This is what most people don't realize. Policy is not abstract. It shows up as groceries paid for, a used car down payment, or a month without worry. Here's the kicker. Even conservative estimates show millions of eligible people miss these credits. The IRS itself reported that millions missed expanded tax benefits after big law changes. 9 million people who qualified missed benefits in just 1 year window. That's not a small oversight. That's a system-level gap. So when you think, is it worth calling a VITA site or clicking through the IRS assistant? Remember those numbers. If you're the one who acts, you stand out. You don't need to chase a 10% investment return. You need to claim what's yours. Okay, recap fast. EITC, Savers Credit, and Child and Dependent Care Credit. 3 credits. Real money. For many Americans, each one can be worth thousands or be part of a combined $5,000 swing. Don't let paperwork or pride cost you real cash. If you want, here's a tiny challenge. In the next 48 hours, do one of these 3 things. Run the IRS EITC Assistant. Contribute to an IRA before the deadline, or gather receipts and provider info for childcare expenses. Put a sticky note on your fridge. Do it. Small actions here have outsized outcomes. If this video helped, hit like and subscribe and drop a comment. Which of the 3 are you going to check first? If you want, tell me your situation. Anonymized is fine, and I'll reply with the most useful next step. Also, if you want a downloadable checklist or a fill-in-the-blank message you can bring to VITA or a tax preparer, I'll put that in the description below. Look, taxes feel boring, but they are a tool. Use them. They're not fair to everyone, and they're complicated by design. But for people who take 2 hours to understand the basics, the payoff can be months of breathing room. This has been John. I'm slightly mad that millions of people miss these credits every year, but I'm also mad optimistic because once you know, you can act. Hit subscribe if you want more practical, no fluff tax and money tips. I'll see you in the next one.